What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is May 25th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to ask a big question. Could the Fed be talking the talk and not walking the walk? Could it be that they're starting to reverse their excessively hawkish monetary policy when it comes to raising interest rates and beginning to engage in quantitative tightening, a reduction of its balance sheet? I want to spend some time to talk about this and what it really means for cryptocurrencies and the broader asset markets as a whole, and how it could serve as at least a short-term relief for these asset markets as a whole. We've got a lot of things to dive into. I hope you guys will stay tuned for this video, and if you like it, consider dropping a like. It's free and it helps out the channel a lot. So let's go ahead and kick off the conversation here, guys. Now, if you're like me and you're keeping on top of what the Fed is saying, what it's doing, from the few key events that we have to look out for, today, later on in the afternoon, we should be getting the Fed minutes on this Wednesday. And this will give us a lot of insights into a lot of key topics from rates, mortgage bonds, and many more items. The Federal Reserve has a few key focus points. All the while it is heavily focused on the financial conditions of the economy, making sure that we're, again, on a smooth course here, as we know that we are likely heading towards some form of recession or slowdown. The big focus point of the Federal Reserve right now is to get inflation under control. Hands down, this is probably the biggest concern the Federal Reserve has right now. That again, all the while I think a lot of us saw this coming over the past year or two, the kind of rampant levels of inflation as the Fed and other central banks across the world printed enormous amounts of money that eventually would in some capacity enter into the real economy and spark inflation. All the while, the Federal Reserve is now in this position where it has to address this to some degree. But the Federal Reserve is in a bit of a catch-22. And all the while, people think that the Fed is going to do exactly what Paul Volcker did back in the 70s and late 80s, or excuse me, in the early 80s, which is just absolutely spike interest rates or the federal funds rate that's going to increase the base cost of capital in the economy and start quantitative tightening and reducing their balance sheet. Well, the Fed is saying they're going to do all these things, and I think a lot of people are taking them at face value. They're taking their words. It's important to understand here that the Federal Reserve can't do all the things that it's saying it's going to do. There is going to be a bit of tango, a bit of quantitative easing, or in this case, at least slow down in the aggressive monetary policy that they have. And this is going to be important to understand when we're viewing Bitcoin and other assets. It's very, very important to keep this in mind here when we're doing technical analysis, when we're understanding whether or not it's a good time to go into the market, depending on the Fed statements. Now, all the while, we aren't going to be getting the next inflation data for May 2022. And I think this is going to be really the pivotal point to see whether or not markets are going to rebound or not. So that's going to be coming up here in a couple weeks' time. But I think we're going to get some comments here from the Fed and the meeting minutes that could start to showcase a bit of reversal in position of the Federal Reserve's comments. While the Fed says a lot, I have a feeling that, again, it's going to play the tightrope here. It's going to try to provide some relief to asset markets here in the short term and state that they're not going to get as hawkish or as strong as they were just back a couple weeks or a month ago. As we have started to see here a slight decline in April's numbers from back in March in the sense of the overall annualized inflation rate. And I think that when we get the next wave of inflation data that comes into the market, that's going to be a secondary kind of booster or wave here going into June that puts equities and other assets into a bit of a rally here. I think there's a lot of hawkishness, a lot of fear. We talked about this in the previous few videos, so it's important to keep that in mind. But all the while, that has been the case that people have been very fearful. Since really back here in early May, crypto prices have been relatively neutral. We've seen Bitcoin holding around right under this $30,000 range for the most part, and the ETH to BTC ratio holding generally back where it was on May 12th. Not showcasing any general signs of strength here, but we are again going towards new lows at this range. And we're still holding back here on this overall long-term support band. Could it be broken? Certainly, right? That's not what we're really betting on here. I'm just signaling here that so far we haven't really collapsed to new lows. But I want to go a bit macro. I want to go ahead and take a look at things outside of the crypto markets, because all the while we can get caught up in analyzing the crypto market. We don't want to get caught in tunnel vision. We don't want to just look at Bitcoin's price. We need to understand right now that the macro environment is having a huge impact on crypto markets. So what other things can we watch here, and what are they telling us? Well, let's go ahead and take a look at the NASDAQ 100 here, the equity markets, right? This is the broad measurement of a lot of the innovative companies and the NASDAQ, top 100 companies here. We can see here in the NASDAQ 100, we can see that we've been generally holding neutral since back here on May 12th. We haven't been really trending lower. We've had a little bit of trending above that previous low here on May 12th, as well as a little bit below. But generally speaking, if we look at the broader trend here, going back here all the way towards when we started to correct since back in November, we've started to enter into a slowdown point here. Very similar to the kind of contestment range that we saw back here from early February to mid-March, or over here as well in late January. And this is a key point that I want to drive home here is that, again, no matter if you guys think that we are in a bear market or, again, in some kind of temporary correction and the worst is past us, either way, we should be expecting to some degree that we are going to see a relief rally. And any kind of TA trader will generally tell you, again, everyone's got different perspectives on this, but that we've got generally head and shoulders pattern here. You've got the decline, right? A retest higher, a decline slightly lower here, a retest back to the neckline in this case, retest higher, slightly higher head and shoulders. And if we come up here, come up to this range around 12,000, you've got a classic inverse head and shoulders here in the sense of price, where that could start to retest higher, get back up here, and test towards this critical resistance range at 12,600 that the NASDAQ has gotten knocked down 2 times here on May 11th and May 17th. But even stepping outside of the equity markets, we can take a look at a lot of other broad measurements that will speak more directly to Fed monetary policy decisions. One of the biggest ones is the 30-year yield on U.S. Treasuries. So the yield on U.S. 30-year Treasuries, we can see here since back here on May 9th that the Treasury yield has been declining here after continuing a massive trend higher. Now, I wouldn't say it's a breakaway of the trend here. We had some pullbacks like this in the past, but every time we have these kind of pullbacks here, especially if we get a breakdown below the previous lows here and start to signal potential trend reversal, that is going to be more and more signs of confidence that the market is starting to call the Fed's bluff. And they're starting to see that the Federal Reserve is not going to take as hawkish of a stance as it's been claiming for the past few months. Like it's been beating it like a drum that it's going to do X, Y, and Z, when in reality, the Fed can do whatever it wants when it comes to actually adjusting Fed monetary policy. They can completely reverse course if they want. I don't think that's going to be the case, but what I think it could be is that they're talking a little too much and they're not really walking the walk. They're going to say they're going to do a lot of things and they're really going to start to backtrack a little bit. And the reason why, and we'll kind of hit on in a moment here as we go through all those metrics. We can take a look at the dollar index as well, right? If the Fed is really going to be sticking to its guns and raising rates, we should be seeing the DXY, or the Dixie here, rising higher. It basically measures the dollar's performance against a broad basket of currencies. When in reality here, since May 12th, around the same time the Treasury yield started to decline, we have started to see a decline here in the Dixie. We can take a look here in the daily here and see the trend here. It's a pretty clear decline here within the metric after having a pretty parabolic rise here against a lot of currencies. This is the case here in the Euro to USD, right? Euro started to bounce and gain some serious ground over the past 2 weeks against the dollar after a pretty steady decline from 1.22 on the ratio back here in just May of 2021, back about a year ago. And outside of that as well, we've got a lot of people coming in here and calling bluff on the Fed here when it comes to the Japanese dollar pair, right? Which had gained a lot of traction here, well over 25% here from the lows back in January 2021. So about a 1.5-year uptrend here for the dollar against the Japanese yen. Now starting to see a multitude of weeks here since back in late April where we've seen a decline in the pair. Japanese yen getting stronger against the dollar. Now, the reason for all of this here that's important to understand is that when it comes to the monetary policy of the Fed, right, and all these markets, it is imperative to understand that the dollar is going to get stronger. The yields on bonds are going to go up if the Federal Reserve is tightening, if it is showcasing resiliency, it's making dollars more scarce in the economy, right? And again, showcasing resiliency and the financial solvency of the U.S. government through treasuries. Problem is, and this is again back to the point as to why the Federal Reserve can't just keep hiking basis points over and over each and every month, and they can't keep stimulating the quantitative tightening. They can't keep reversing those mortgage-backed security purchases and government bonds, and inevitably starting to dump them on the market. They just can't do that. The reason why is because not only the economy is already in a weak point, that's just always been the case here. The Fed stimulus hasn't really helped revive the economy. It's helped stimulate financial assets. But on top of that as well, the important thing to understand is all of the debt in the economy in this case. If the government, for example, wants to issue new bonds, if people want to borrow in the economy, the federal funds rate increasing like it is going to cripple those who want to actually take out new debt and borrow in the economy. It's going to make the federal deficit start to balloon big time. The net interest on that debt that we have to pay go up over time. And it will serve as a huge weight there on the solvency of the United States in the long term. Right? It might be a short-term win for the Fed, showcasing this confidence, but in reality, it's going to come back to bite them in the butt. And that's a reason why we need to understand that just like back in the 70s, if we watched that decades-long inflation, we had spikes up towards kind of the 8 to 9% range. We came back down, cooled down a little bit, 3 or 4%, but still didn't get back to that target range, right? And then we started to accelerate back higher because people started again to liquidate assets, spend more money in the economy. There was other supply chain-based issues, and boom, you get back to the same exact issue where you're back at double-digit inflation. I think that that is what's going to play out here. Now, all the while here, we might see a kind of short-term relief rally in the equity markets, and we are keeping an eye on these metrics. I think another thing that's important to note here is taking a look at altcoin dominance. Now, I understand we haven't talked about altcoin dominance much here, and it did technically break the support line that we've been talking about for a long period of time here. So that's an important thing to note here. That dynamic here has been broken, which again might signal a longer-term kind of de-risking or de-exposure from altcoins. But I have to say here again, all the while we might roll over here in dominance. It's interesting to see since May 13th with all the growing fear in the market that we haven't just absolutely collapsed lower here. You would expect a lot more sell side pressure in the altcoin sector. Now, one of the altcoins that's held up really well here is today's sponsor for our video, and that's Kava. Kava has really just come out strong from this sell-off since back in late April going into the early part of May. Now, for those of you who don't know about Kava, Kava is aiming to do something pretty exciting. We've talked about them a lot here on the channel in the past few years, really heavily back in 2020, but they've made a really interesting pivot within the Cosmos and Ethereum ecosystem. What Kava is aiming to do here, and if you guys haven't already, I definitely recommend you go follow them on Twitter. They got a lot of great content coming through there, is they're aiming to be a lightning-fast Layer 1 blockchain that combines the interoperability of the Cosmos ecosystem and the developer support of Ethereum. Plain and simple. So what does this really mean here? Well, you're basically taking with Kava 10, this Kava 1.0 new network upgrade and stuff that's going to be bridging two of the most popular developer ecosystems and developer tools and language frameworks into one powerful network. So you've got all of the developers and resources and framework that people are familiar with in the Ethereum ecosystem with Solidity development combined with the consensus scalability and solidarity for developer tools that comes from the Cosmos SDK. So basically, in this case, Kava is bringing the Atom ecosystem, the ETH ecosystem, all into one in a cooperative environment where you can build in both frameworks and basically build DeFi protocols that allow for users from all these ecosystems to come in, as well as developers. Now, why exactly is this really big here? Why is it here that this is going to offer a lot of powerful features and capabilities that just weren't possible before? The way I think about this combination of Ethereum and Cosmos is that when we're starting to combine these two together, it basically builds a liquidity vortex for all these different layer 1 blockchain protocols. So for example, even if you're not a fan of Ethereum, you might be using, for example, Avalanche, which is EVM compatible. And if you're a fan of, Avalanche, the great news is that any DeFi apps that run on Avalanche or Ethereum can run simultaneously on Kava's network because it has the capability to support the EVM or the Ethereum virtual machine. Right? So that's what EVM compatibility means. It's going to allow for all these applications to come in. It's going to allow for Kava to provide bridges for liquidity to move from these chains into one shared ecosystem where users of the Ethereum blockchain or Avalanche or any EVM compatible chain can now interact with same or similar DeFi applications with Cosmos-based assets. This is really exciting stuff. Now, I really recommend if you guys haven't already, if you happen to miss the interview I did with Scott Stewart, who's at the head of the Kava Labs team, I recommend you guys can definitely check that out. But there's a lot of great tweet threads that he's put out here talking about what they're doing here to really bring Kava to the forefront. They have an over 40-person team here with building robust Web3 products. They've got $750 million in the Kava Rise program, which I'll talk a little bit about later on, bringing developers into the ecosystem. But on top of this as well, it's important to understand that, again, as we talked about, the key value proposition here is building one kind of vortex of liquidity, one big platform where a lot of these resources come together. And the great thing is that as they're providing support for the Ethereum ecosystem, they're bringing along all the key important factors. The graph, which is helping to build price data, as well as Chainlink oracles, support for MetaMask, DEX contracts such as Uniswap, all kinds of different things that will be available on day one to either build or use on the Kava network. So I think this is really exciting, but I think one of the biggest things that really kind of hit it home for me and put it in visual perspective is this graph here. That just again hits home on the point here that it's really bringing in something that's going to bring in all of the solid developer work that's going on a smaller chain like Cosmos that brings kind of the consensus mechanism, Tendermint, as well as the Cosmos SDK, which I have to tell you all is probably one of the most robust. Cosmos is one of my favorites. You guys know I like Cosmos and Radix. Those are some of my favorite alternative layer ones outside of Ethereum. Cosmos has been building behind the scenes big time for the past few years, and it's got a great developer ecosystem that I think has yet to really kind of surface up as much as the value that's being built. So combining that with Ethereum can be incredibly powerful, and that's exactly what Kava Network is trying to do here. So if you guys are interested to learn a little bit more about the developer incentive program, where they're going to be putting up $750 million worth of Kava for developers, I highly recommend you guys check into that if you're a developer and want to build an application yourself. They've also got as well the $250,000 Kava 10 giveaway, which you guys can learn a little bit more about as well to participate. But I highly recommend you guys take a dive into it, because it's got to be one of the more interesting altcoin projects I've seen here. And again, seeing the resiliency out of the sell-off in the market, again, I think just speaks to that. I'm not telling you guys to go out and buy Kava. That's a decision you got to make for yourself. But I have to say, it is one of the interesting layer one plays, doing something really experimental and exciting that could really start to pull in a lot of the value creation in the space into one single chain, especially with the developer incentive program. Kava has a big focus on bringing in not only developers into the ecosystem and making sure that it's a developer-owned network with the Kava Rise program. Probably the best I've seen in the space so far, at least in terms of dollars. Now, one thing I want to go ahead and dive into as we were taking a look at this conversation here is take a look at some macro factors in the market. We'll dive into some other ones here, but I want to dive into Bookmap here, for example, right? We can take a look here at the market order flow, still holding up generally positive here just over the past few days after an already strong week to 2 week trend, which we took a look back on in the previous video. So the market order flow here is looking quite healthy. But outside of that as well, if we take a look here at some of the macro indices, again, I want to step back from the crypto markets. I want to take a look here at what's going on in the traditional markets. All the while, the VIX has been holding elevated here throughout late April and May. It's been holding above this kind of point here around the 25-point range. So volatility is still holding up consistently high. We are starting to see a general decline in the spikes on the VIX. And this is something I want to hint here, right? Back here in January, right, the call options volume in the S&P 500 setting its relative high here. And since then, we really haven't visited back into this range. In fact, we've been setting lower levels, and even here really in the past few weeks, as we turn into the month of the month of May, we've just started to see lower and lower retests here for the VIX, showcasing what's effectively known as a divergence. All the while, equity prices are coming back down towards that low range, potentially even setting in lower levels. We are seeing a decline in volatility. Basically, in this case, lack of fear in the sense of volatility and uncertainty in the market, even while prices are starting to decline lower. A divergence like this can actually be a really positive sign that markets are getting oversold and that confidence is starting to grow back into the market here, even as prices starting to teeter lower. This can mean here Couple of things. All the while, market order flow here, when people are kind of panic selling their equities, the limit orders are starting to provide that kind of way to support there, and we're not seeing as fast of a decline in price. And that's starting to help mitigate the volatility here. Institutions might be stacking up here at these lows, waiting for a soft landing and a rebound as the Federal Reserve starts to revert course. So there's a lot of interesting charts you guys can keep an eye on like this. I would say if we get a roll down here back to 25, have a close on the VIX below this range, that's kind of your telltale sign that we're in for a relief rally in the markets. But I want to go ahead and talk a little bit about Bitcoin here, guys. Get back to center here. I know we're mainly a crypto channel here, so I know you guys are probably wondering about what this all means for Bitcoin. I think the important thing to realize here, as we've hinted on in the previous few videos, is a key point of not getting caught 2 steps behind. I'll beat it like a dead horse here, guys. Again, and I want to emphasize, as we talked about in previous videos, we're not saying here that we couldn't come back down into this range here, right? That we can never retest a price down here. I think it could be very reasonable that we come down into this range of $27,000. But I do not think we're going to be setting a new lows. I think that more than anything, we've got a chance to start rebounding and taking it higher here. And no matter if we revisit down to this range or we just start trending higher now, or even pushing sideways for a little bit longer, we have gone through what I feel is the temporary maximum pain. It's not to say that in a couple months' time, after we do a rebound, we couldn't come back down to 20K or whatever. It's not that we couldn't come down and touch that 200-week moving average. I know a lot of the people out there are watching that. That is a solid time-tested metric, and I wouldn't take it out of the woods in this case that we're going to revisit that. But my major point is this, that right now is not the time to panic. When the fear and greed index has held at and maintained a consistent 10 to 15 point range, when Bitcoin has been consolidating sideways after a capitulation candle, and as we talked about the other day, after seeing a heightened level of volume here in the Bitcoin pair against the dollar, similar to the sell-off we saw back here in May and many other sell-offs in the past. This is a telltale sign that it's not time to panic now, especially after a 50 to 60% plus decline from the all-time highs. It's just not the time to panic, guys. We should be expecting some kind of relief in price here, much more likely than any further correction. And again, no matter where you stand in the market, what label you want to toss at the market, we're asking a very simple question. Is it really a time to sell, or should we wait for greener pastures here in the short term, even if we want to take profit? Or should we generally expect higher prices? All right. It's only a question of whether or not it's a time to really buy or sell. That's why you guys are here. And I can't tell you guys exactly what to do. I'm not here to give financial advice, but I want to give some healthy perspective to, again, not make that mistake that I had made many times back in previous markets of getting caught 2 steps behind. Anyways, guys, that's it for today's video. I've rambled on enough. If you enjoyed it, if you can tolerate my rambling as long as you did, consider dropping a like, consider subscribing, hitting that bell icon. And if you guys are interested in Kava, you can definitely check out the links down below in the description, as well as signing up for a subscription to Bookmap if it is of interest to you. But anyways, guys, that's it for today's video. Thank you all so much for watching, and I'll see you all in the next video. Take care, everyone.